Good afternoon, everyone, and welcome. This is a TradeStation webinar series, and I want to welcome and thank you for joining us today. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. It's a pleasure to be here, presenting this webinar. I'm going to be the host for you today, and our presenter is going to be Brandon Wendell. We'll introduce him in a little moment. But before I pass the microphone over to him, I just want to make a couple of announcements and maybe go through some of the disclosures. I see that some of you have already started using the chat, so thank you for that. It's always great to see where everyone is connecting from. So if you share your city and state, hello to everyone that is joining us in this presentation. Thank you for taking the time to do so. Here are the disclosures. We have to do this on every presentation, so hang on tight. Every symbol and idea that we talk about is for educational purposes only. It is not a recommendation of TradeStation. Also, active trading is not suitable for everyone. Past historical performance is no guarantee of future results. And I want to make it also clear that this is a third-party presenter that is not affiliated with TradeStation, but we're very pleased to have him with us because he brings a lot of experience in trading, specifically what he's going to talk about today, which is trading futures spreads. So be aware of the risks. And if anybody has any questions about these disclosures, please visit our website, www.tradestation.com/important-information. So thank you guys for being here. As I said before, this presentation is going to be all about future spreads. And TradeStation offers a technology where you can do future spreading. So that's one of the good advantages of being with TradeStation, that you can trade multiple assets. And Brandon, in his presentation, he's going to be using TradeStation's own Futures Plus, which is the platform you use to trade future spreads and also options on futures. But today we're going to concentrate on futures spreading. So hopefully you guys enjoy the content. Brandon Wendell brings a ton of experience in trading. He's been trading basically all his life. Well, I'm not sure if all his life, but many years of experience that he brings in. And of course, we're very pleased to have him with us. So Brandon, are you there?
I am. Thank you. I don't know if you can hear me. My camera, I can't turn it on. So
yeah, we can certainly hear you. So let me go ahead and turn off my webcam so it's not distracting. So Brandon, welcome again to TradeStation. So
thank you for having me.
I'm going to go ahead and stop my share because I know that you have a full PowerPoint deck to share with us. So go ahead, and the floor is all yours, Brandon.
Excellent. Okay. Well, yeah, I'm going to go ahead and share my screen as well. And then I don't know who's the host, if it's you or Manolo, but if you can turn on my camera, I'd like to turn that on as well. So let's see if we can get that going.
Yeah. Give me just a moment. Let me see if I just need to make you. That's interesting, because how do we do that? Manolo, do you know how to turn Brandon's camera on? Okay, you got it. Perfect. Thank you.
There we go. And yeah, so great. Now you can actually see me and hear me. And let's see, there we go. That's the background I wanted. All right, so welcome everybody, and thank you for having me, Jesus. I appreciate it. So my name is Brandon Wendell, and I'm going to talk a little bit about futures spread trading, and this is an introduction to futures or trading futures spreads. Now, keep in mind, we are not going to be looking at options. Most people, when they hear the word spreads, immediately think of options. This has nothing to do with that. This is dealing with futures contracts in a different manner. So I think Jesus already mentioned a lot of these things. I want to cover for myself. I am not a registered broker dealer or investment advisor. I simply trade for myself, and I also teach trading and investing. So I'm not giving any personalized recommendations or personalized advice about your trading activities. There's always risk involved in the markets. And when we look at things here, it's from an educational standpoint. I'm also not subject to any trading restrictions, so I can have a position in a security, initiate one at any time, and just want to put that out there. So as I mentioned, today's agenda, I want to start off with what the heck is a spread? And then, okay, great. Now I know what a spread is, but why should I even think about trading those? And we'll talk a little bit about some of the benefits as well as the risks. We always got to keep that in mind, that you cannot have any benefits in the markets without some sort of risk involved as well. So we got to make sure we balance that out pretty well. And we'll talk about how those spreads are traded. As Jesus mentioned, I do have loaded up here TradeStation Futures Plus, which is a platform that actually allows you to trade those futures in this, well, again, future spreads in their platform. Yes, it is recorded, and I think it'll be posted a little bit later. I'm not sure exactly, but you can talk to them about that. Anyway, I don't control it. I'm a third party. Anyway, so hey, Missy, how you doing? So if you don't know who I am, shame on you. No, I'm just kidding. Basically, I've been involved in the markets for about 23, 24 years. And I am also a chartered market technician. So I have a lot of experience in analysis of the markets, where basically it's kind of like a master's degree in technical analysis. That's what the CMT program is. I actually got involved in the markets initially as a retail broker and then moved into back office operations. So I handled order flow for, they call it agency desk operations. And it was kind of cool. It got me exposed to the way the markets really move, which is order flow. I was then hired to work for a private hedge fund in La Jolla, California. And I did that for a little bit and then moved to just simply trading for myself. I didn't want all the stress of having to get all dressed up in a suit and tie and sit in front of a computer to talk to nobody. Now I get to dress in my bow ties that I like and talk to you guys about the markets. So the reason why I teach, honestly, people always ask me if I trade, why do I bother this teaching stuff, is it's a lot of fun. So trading can be very solitary, very isolating. And I prefer to be able to communicate with people. And I still do. I do online mentoring, things like that, where I can talk to people online as I'm trading and just stay involved with the social aspect of the markets. It's kind of neat. So I got that glowing endorsement there at the end there. My mom says I'm a really nice guy. So if you want to stay in touch with me, if you have more questions regarding the spreads after this presentation, one of the easiest ways to get a hold of me is via Twitter. I'm at TraderBDub. Be careful. There's a couple people who are copying me and making some fake profiles that are slightly different in the name, but there's only one me. So TraderBDub. You can always direct message me there, follow me on Twitter, or just get in touch with me. Anyway, moving along here, because this is not about me, this is about you and what spreads are all about. First, before I get started, I'll take a little poll here. You can type in 1 for yes, 2 for no. How many of you have traded futures spreads before? 1 for yes, 2 for no. Okay, so just a few people, mostly new people, so that's fine. Yeah, if you're not on Twitter, you can always find me. Just search under my name. You can find me that way too. And cool. There's a lot of people in the room here. That's great. So a lot of people brand new to spread trading. That's fine. That means you have no bad habits, right? So even if you do have experience in that, obviously it's not going quite the way you wanted to. So that's why you're probably here to pick up a little bit of extra information to help you out, right? So first of all, what the heck is a spread? Well, a spread is buying a contract while simultaneously selling a related futures contract. Okay. Oh, so you trade options and learn how to spread futures. Yeah, they're similar but different. An option spread is basically about the same thing. You're buying one contract while simultaneously selling another. It could be buying a call, selling a call, buying a put, buying a call. That'd be a straddle. So we're doing something similar using futures contracts. We're going to buy one and sell one at the same time. And the reason why we're doing this, well, first of all, we could do it as one transaction, or you can do what's called legging in. Legging in is not the best way to trade spreads. The best way typically is all in with a single transaction, a single order. And that's what TradeStation Futures Plus allows you to do. I'll show you more of that in a bit. So the reason why we're doing this is simply to take advantage of the relationship between two related securities changing. Okay. So let's see. Does delta relate to spreading futures? Yes, it does. Absolutely, it does. And I'll talk a little bit about that. So there is delta that we have to worry about. It's not as critical as it is with being delta neutral. Well, I guess it kind of is in a way. I'll show you. Again, we'll get to that. But anyway, when you're looking at a directional trade, say we look at crude oil for September. I know this one already expired, doesn't matter. But looking at crude oil on this chart, this line chart, we see it's moving down, and we have two ways of trading this. We can either buy the contract if we expect the prices to go higher, or we can sell the contract when we expect prices to go lower. And that's just a simple futures trade. Now, when you take a look, remember that September contract is not the only contract available, especially with physical commodities like crude oil. You might have, heck, you can go out at 5 or 10 years from now and trade those contracts. There won't be a lot of volume, but they're available. So if we take a look at the December contract, you can see that the two contracts, September and December, they move in the same direction, but they don't move at the same pace. And that's what the spread takes advantage of. Basically, the spread is that white space between those two contracts charts. That's all it really is, the price difference between the two. And that can either get wider or narrower. And we're going to be able to trade that using a spread trade. So there's actually several different types of spreads, really two main types, and then a couple subcategories, if you will. So the main type of spread that I just showed is an intra-market spread. And basically, when we're looking at intra-market spreads, you're using the exact same security, but using different months. So we could do, for instance, the NASDAQ December contract of this year, 2022, versus the March contract of 2023. Okay. When you think about it, well, let me go back a moment here. Taking a look at these two contracts, for instance, the September contract at the time I took this picture was considered to be the front month contract, meaning it had the most volume and was the heaviest traded. Typically, the one, and by the way, the other ones, if you're not familiar, anything other than that front month, which is also known as the near month, the other ones are known as the back or far months. So the front month or near month is the contract that always has the most volume. Okay, it's not always the one that expires next. You got to be careful with that. It's just the one with the highest volume. So then we have the back or far months. Well, what you see in this move is that both of them are moving down. However, the front month, because it has more activity, more volume, will typically move further and faster in the direction of the trend. So when we look at an intra-market spread, we can either buy the front month or sell the front month, and you would simply do the opposite on the back month. And here's why we would do this. If we wanted to do a bull spread, this is simply taking advantage of, instead of buying the NASDAQ, or in this case, I have lean hogs. Instead of buying lean hogs, you can actually do a bull spread on the lean hogs. You would buy the front month and you would sell the back month. And you think about it, the front month should go up faster because, again, it has more volume and more activity. So, well, continuous contracts are a little bit different. Okay, with continuous contracts, what you are doing is these are specific, contract specific for that. Here, I'll just show you. I'm going to go out to this is trading view, but for instance, HEZ 2022. This is the current contract for lean hog futures, December 2022. The problem is when you go back in time, you see that contract was only alive, if you will, or tradable for a certain period of time. So if we want to go back in history beyond the life of that current contract, we need to do basically what is called a continuous contract. It links together all the old contracts. So I could change my symbol depending on the platform you're trading on. And now when I go back in time, you can see this goes on almost forever. So, and you'll notice there's a lot of gaps going on there because that's when you jump from one contract to the other. Okay. Yeah, I use the RSI quite heavily on my trading. So I've got that at the bottom. I'm not going to go over that right now. Maybe another webinar if they'll have me back. But basically, yeah, this is just continuously attaching all the contracts. As the old one expires, it drops off and brings in the new contract and just links them all together. That's all. But anyway, when we talk about a bull spread, you're always going to be using specific contracts. Okay, meaning we will always have the root symbol, the month of expiration, the year of expiration. Okay. Yes, Alex is bringing up a great point. You can't actually trade the continuous contracts. You can use it for charting, but you always must trade the specific contracts. And if you're using TradeStation, they have a continuous contract by using the @ symbol and the root of whatever it is you're looking at. So I don't have it open right now. I do have, actually, I'm not sure if they have it on Trade Plus. But if I were to go in for a contract here, actually, I can do that. This is TradeStation Futures Plus. So if I were to go into the symbols, say ES, you can see I've got a choice of the different instruments with the different expirations right there. And if I want to do continuous, I'm not sure if it's going to be the same symbol here or not on this platform. Let me just see if it lets me. And it's loading right now. So I just did at ES, like shift 2, and there it is. And I'm on the wrong time frame to really view this. So let's go to a bigger time frame. We'll go out to daily. And actually, while I'm also at it, and change my settings here because I don't like the way this shows up right away. And the nice thing about TradeStation is you can make it very customizable to whatever you want to see. First of all, I hate grid lines, so they're gone. And I need to be able to see my wicks on my candles and the outlines. So that, my friends, looks much better. Now, I'm not going to bother with the RSI right now, but I'll delete the Bollinger Bands. But there's my chart. And this is actually still only showing me the December contract. So I'm not getting the continuous contract. But again, I wouldn't really need to use it in this purpose. So I'm not going to bother looking at it. But yes, typically it is the at ES for continuous contract. Anyway, a bull spread, you're going to buy the near month and sell the back month at the same time. So if I wanted to see that, well, I'll go into the charts in a moment. But for instance, here I've got an example of soybeans, September 2022 versus January of 2023. So back here, which was in July, if I thought that soybeans were going to rise in value, I can buy the front month contract while simultaneously shorting the back month contract. Okay. And what happens if I'm right, you can see that the front month moved up further and faster. So my long made a profit. However, my short lost money because the back month also went up. But when you take a look at the number of dollar signs there, you can see net positive because you actually make more in the long than you lose on the short. Okay, so that's why we do, well, not why, but that's how you do a bull spread on futures. You are buying the front month, selling the back month. Simple. Now we have the opposite. If we think the markets are going to go down, we would do a bear spread. You simply sell the front month and then buy the back month. Okay, so in doing that, you can see I used crude oil September versus December. Back here at the beginning of the trade in June, you would short the September contract, that's the U22. At the same time, you'd be buying the December contract, okay? And you expect prices to go to the downside. Well, the short made money, but the long lost money. However, the short made more than the long lost. So you're net positive in the trade, that's it. Bull and bear does not necessarily tell you whether the underlying is contango or backwardation. If you're not familiar with those terms, contango, I'll do this. I don't know if I have it open right now. No, I do. I'm going to go to paint for fun here. And basically, we have a couple terms that you need to be familiar with when it comes to spread trading. One is contango. Okay, and let me see if I can enlarge this. Come on. There we go. So contango, that is when the front month is the cheapest. And then as you go further back in time, the more expensive the contracts become. Basically, time has a value. So the front month is the cheapest, and as you keep going back in time, the contracts become more and more expensive. That is a normal situation, by the way. Okay, contango is the normal situation for most markets. So probably the easiest way to look at this would be for me to go out to the CME website and just look at a quote. You know, look at crude oil, see if that is contango. So looking at the quotes on crude oil here, and you can see it on your platform as well, just as easy. But we look at the October contract, and right now that was trading at 84.19. Notice November 84.20, 80. Whoop, that is not contango, is it? Look how the contracts are getting cheaper the further you go. So that is something called backwardation. And the front month think the most expensive contracts get cheaper further out. And that is not normal. It signs usually, not always, but usually a bearish sign. But it's not always, but it's often bearish for the markets. So when you take a look at what's going on in crude oil right now, crude oil has been in a bit of a bearish trend. So it's not surprising to see the further out you go in time, the cheaper the contracts are, because they're expecting prices to drop further in the future. So if we change our quote, perhaps to the NASDAQ, there we go. Let's see if we are in contango there. And we are. You can see the December contracts at $11,939. And then we go to 12,000, 12,151, and so on. So that's contango. That's a normal market situation. But it doesn't necessarily mean that when something's in contango, you should be doing a bull spread. When there's backwardation, you should be doing a bear spread. There's more to it. Okay. So yeah, it's a cost of carry, as Richard's mentioning. He's saying storage and interest to store. It's basically what's called the cost of carry. And that, if you got wheat or gold, you got to basically store it. And that's a cost. So the further out contracts are going to be more expensive. Anyway, so we have these two types of intra-market spreads. If we think the markets are going to go up, we put on a bull spread. If we think the markets are going to go down, we put on a bear spread. So we want to try to keep this somewhat simple if we can. So the next type of spread is what's called inter-market spread, meaning different securities. They have to be somewhat related. You can't just pick two random securities. But and by the way, it says same month. We actually don't always have to use the same month. Okay, so we have gold versus silver, or in this case, I'm sorry, I put it as silver versus gold for February of 2023. So we're looking at related securities that normally move together, but don't always at the exact same time. And we take advantage of that mispricing. So I've got an example here of Dow versus NASDAQ. You can see at the beginning, they were very close together. I'm on a percent change chart. And unfortunately, they separated. So you see the spread widened. Well, we could have bought the NASDAQ, which was relatively cheap, and shorted the Dow. They came closer together. The long would have made more money than the short lost. And that's how you take advantage of an intermarket spread. Or the other way. Here, you can see that we could have shorted the NASDAQ, expecting that the markets were going to go down, and the Dow didn't go down as much. So we could have gone long there and lost a little on the long while making much more on the short. So if I go out again to my charts here, wrong one. Where am I? There it is. If I were to go out, I've got a comparison chart that I created. The contract ratio is going to be different. I'm going to get more into that in just a little bit. Don't worry. So for instance, here I'm looking at a daily chart now, and we've been declining since about September 12th. So if we look at the decline that we've been having here, you can see the NASDAQ, which is in that darker purple or magenta color. And you see the legend over here on the right. That's been dropping further and faster than the other markets have. The Dow, as a matter of fact, is not moving down nearly as much. So in September, if I thought the markets were going to drop and I knew that the NASDAQ was likely to drop faster than the Dow, I could have shorted the NASDAQ and bought the Dow at the same time. And that would have been an inter-market spread. Let me show you. So I'll bring up here the NASDAQ. I'll use the December contract, doesn't really matter. And I'll introduce with it the Dow. Now, I apologize, I'm using this platform because I'm a little more familiar with it than I am on Futures Plus right now, but you can do a lot of these things just on the same on Futures Plus. So let me go into my chart and change this. Hey, where is it here? Symbol. I forgot how to change it now. I'm just going to try to change it to a line chart to see the difference between these two. Actually, also, yeah, they're on percent change anyway, so that's fine. Oh, it's right here. Duh. Line chart. Blanked out there for a moment. So again, if I go to that September 12th area that I was talking about, right about here, and zoom in right there, you can see that the Dow in that yellow didn't drop as much as the NASDAQ did. right there. So, oh, thank you. Yeah, I've been doing the computer stuff for quite a while. My first computer was a TRS 80 Tandy. I don't know if you guys remember those from Radio Shack. Back in the early 80s, actually. Anyway, so that's one way of trading. Again, the spreads, if you expect one, yeah, trash 80, exactly. You remember that, Ron? So if they're moving in the direction, one might move further and faster than the other. That's why you do an intermarket spread. So when you're charting the spread, you actually don't chart the way I just did. Okay, you use what's called a spread chart rather than trying to put them separate and try to measure the two. And it's really easy to put together a spread chart. Again, you can do this on multiple securities and multiple platforms, but TradeStation Futures Plus, you can actually do it on the normal TradeStation, but it's easier to do it on Futures Plus because you can trade it there. So the spread chart is taking the white space between those two securities and just drawing it out as a line. Makes it much easier to see. And you could use candlestick charts for it too. So as an example here, I've got corn, and we're using corn December 2022 versus March 2023. And you can see there's my chart is moving down. That is a line chart of the spread. It's basically the December contract minus the March contract. So the way it's created is this. Right now, the December contract from 2022 was trading at 610 and 2/8. And then you had the March contract at 618 even. Okay. So if you just simply subtracted one from the other, that's what you get, negative 7.6. There you go. All right. So can it work intraday? Yes, it can. Absolutely. I can go back and let's do that intermarket spread I was just talking about. So I'm going to delete this. I'm going to bring over, we'll make it a candlestick chart for fun. And I'm going to dial in here, NASDAQ, like I had, minus YMZ 2022. So this is the NASDAQ minus the Dow. And we're at a negative 18,000. Okay, you can use negative numbers for this trading, basically. Now, this is not actually the chart I would use. There's a little bit more I have to do here. But you can see it's simply the price of the NASDAQ minus the price of the Dow. And that's the answer. Okay. So if I want to change this, you can see it's a daily chart. You could take this all the way down to a 5-minute chart if I wanted to. And you can see you could definitely trade this intraday. There's movement there. You just have to be able to manipulate your contracts and get in and out quickly enough. So how do you recognize it as a spread when you're trading? Great question. Let's see, where's the other browser? I didn't close it out, did I? No, there it is. It's right here. So if I go to my trading platform, there's a couple of ways of doing it, but right now I've actually created a chart. Let me do it right here. Securities. Yes. See if it shows. Nope, it's not there. Hang on. Auto spreader. There we go. I created this one earlier. And this is a chart. As soon as it loads, it takes a few moments to load, unfortunately. But when you're doing spread trading, usually it's not a very high speed situation. A lot of the spread trades are typically going to be longer term swing trades. We might be in the trade anywhere from a couple of weeks to even a few months. So it's not very often that I do an overnight trade when it comes to spreads. Usually it's several evenings. Okay. So it's loading up the chart right now. It's weird. It's not looking quite right. But yeah, it's still loading. There's the thing going in the bottom corner. What happens is, yes, you can put it in all at once. You can see that I've got what's called the MD Trader right here. And actually I can load it up when I have it on my chart as well. Where is it? No, it still has to load. But once it loads, I can bring up what's called MD Trader, and it's a matrix basically. So I can trade the spread on the matrix as you would normally in TradeStation. And yeah, it goes all in at once. And they recognize in the back office as a spread. And you'll see why it's important to be recognized as a spread. So let me continue on with this and I'll answer more. When's the best time to trade it? Honestly, whenever. These are swing trades. So I take some of these trades in the morning, in the afternoon, in the evening. It's whenever it hits the price level that I want. That's the nice thing about futures trading is that you don't necessarily have to be at your computer at a specific time. You can set up the orders and let them go. Volume is relevant. Yes, we want to make sure that we're trading something that has enough volume to get in and out. Okay, so basically, in a nutshell, futures spread trading is simply trading the difference between two related securities. That's all it really is. Let me just check something out here. Okay. Sorry, I was checking to see. One thing I wanted to point out, I thought it was in my slides, but I don't think it is. Before I go any further with this, I'll go back to my NASDAQ versus Dow. You do want to be neutral, number one, when it comes to these contracts. So we have to worry about the deltas of these contracts. Okay, just like you do with the options trading. Delta neutral means that you're balanced in the direction of both securities. So it doesn't matter if they both go up or both go down, you could still make a profit. You're only worried about the spread changing. And you actually do have to balance that properly. It's interesting when you go into the CME Group website. Let's see, there we are. One of the things you can look at is margins. And you'll notice when it comes to margins, you've got first one is outrights, and that's usually what everybody looks at. For whatever reason, the CME has taken away some of the columns they used to have. They used to have a column for initial margin. That's gone. You know, you can go into TradeStation, and it's real easy to find there is under pricing, futures margin rates. It's right there. And that'll tell you right here, intraday initial margin or overnight initial margin. Unfortunately, they only show the maintenance margin on the CME website, which is not a big deal because the maintenance margin times 1.1 is the overnight margin. Okay, let me say that again and I'll type it out here. Basically, initial margin is 110% of the maintenance margin. So what you do to calculate it basically is the initial margin is equal to the maintenance margin times 1.1. That's it. So if I want to know on the S&P, how much do I have to come up with? I go over to the CME Group website right there. It shows $15,000. Well, you multiply that by 1.1. And you got $16,500 of overnight margin. Okay. And of course, on TradeStation, as I said, if you were to go right here, it should show you. And they adjusted the overnight margin. So it's not as high. They haven't updated it on the website yet for the CME. So anyway, the reason why I bring that up is, oh, it's on the NASDAQ. That's why. NASDAQ. Wait, where is it? There it is, 16.5. It is the same. Thought I was looking at the S&P. I confused myself. So there it is. Now, going back here, you'll notice there's other columns. Intra-market spread. Okay, now remember, for trading the NASDAQ overnight, it's $16,500 for one contract. But if I do it as an intra-market spread, first, before we get to the maintenance fees and everything, you'll look right here. It says something called, see something called ratio. Actually, let's zoom in. There it is. You can see ratio and side. Ratio is your delta. You need to do 1-to-1 in this case. Some of the contracts are 3-to-2, 6-to-5. And the reason why you're doing that is to balance out the volatility and the tick movement of those securities. So that way, if both securities go up or both securities go down, you don't make or lose anything. It's the difference in the way they move that makes you profits or losses. Okay. And there is a span margin calculator on the website. Yes. So it's a little bit easier to use than this. You have to log in, I believe, in order to get it. When it says side A, side B, if side A is a long, then side B is going to be a short. Or if side A is a sell short, then side B would be the long. That's all. And you got to make sure you're looking at the right contracts. So if we're doing December and March, this was it right here. And you can see the maintenance margin is 3,300. So therefore, the overnight margin to hold a bear or bull spread on the NASDAQ is only $3,300. That's pretty cool, isn't it? So we went from 16,500 overnight to 3,300 overnight. That frees up a lot of capital. So spreads reduce a huge amount of margin. And the reason why is because your risk is a lot less. And I'll go into that in just a moment and show you why. Yes, Craig's bringing up a great question. Do you teach risk management concepts for spread trading? Absolutely, yes. Risk management is probably the most important thing that you could possibly learn when it comes to trading. If you don't protect your money, you just don't have it, period. So we have to protect our money. That's job number one. Another question that came in from Roberto. is, do you have to get out when the front month is expiring? Yes, you do. Yeah, you don't want to hold these into expiration typically. We want to get out of these contracts before expiration. So from time to time, it might be required for you to roll your position as you would normally in futures. I try to buy and sell the contracts far enough out that I don't have to worry about rollover while I'm in the position. Okay. And let's see what else. Is it possible to build a strategy in easy language that triggers entries and exit for the spreads? Absolutely. Yeah, especially on easy language. You should be able to build something like that. And yes, you can roll one leg and not the other. It just depends on the broker and how they handle your margins. So continuing on here, where was I? When it comes to trading the future spread, so we understand there's the intermarket and intra-market. Intermarket, two related securities. Intra-market, we have a bull spread and a bear spread. So you can go either bullish or bearish on one security with different expirations. So a couple of reasons why we want to do this, and I kind of went over this already. First of all, margins are a fraction of the cost that it would be for directional trading. Margin is also a measure of risk in a security, if you're not familiar. If the margin is higher, there's more risk. If the margin is lower, there's typically less risk, not no risk, okay? There's always risk in the markets, but yeah, you're stuck in a contract you can't roll. You can't get out of the September contract if they've already stopped trading. So you can't roll anymore. It's too late. You always have to roll before expiration. So anyway, let me get back to this. You can see NASDAQ futures, we already went over. Overnight margin is 16.5, but spread margin was 3,300. Crude oil. If you want to trade crude oil right now, there's a little bit of volatility. So the margin went up to $9,400. But a bull or bear spread on crude oil would be only $2,000 margin. You go to the bonds, and somebody was asking, could you do VIX versus the bonds? Possibly. You can create your own spreads. You literally can. It's just up to the broker whether they recognize it and give you the margin rates for it. Some brokers will, some brokers won't. Okay. Some of them, there's different kinds of spreads. There's exchange recognized spreads, and then there's customized spreads that you create. The difference you'll see when I go into my TradeStation Futures Plus again, wrong page, sorry. Actually, I should merge these. It'll be easier for me. There we go. So when I go into Futures Plus here, you'll see when I'm trying to find spreads, for instance, and that one's finally cleared up. There's my chart, by the way, on the NASDAQ versus ES. But more importantly, going into this, as I'm trying to find spreads, let's say I'm looking at crude oil, I can bring up the list right here and it shows individual securities. Missing the spreads. Where is it here? There we go. And I go to CME and futures, just the individual futures, but spread. Now I can bring up spreads. Let's see if I can go down to CL. It was too far. Not sure which one I need to use here. That's MCL now. Anyway, there's some spreads that are created here. There we are. That's what I want to CL. So you'll notice, well, you can't probably see that. So let me do this right here. I can do calendar spreads, October, November, or currently we're not, we are trading the November contract. So there I can do November 2022 versus next year, right there, 2023, or even further out. But I can also, instead of taking these spreads that are already recognized by the exchange, I can create what's called auto spreader. And that's where I can create my own spreads. And you can actually share spreads with other people. So some of those are spreads shared from other people. I created that NQES spread. Now, one other thing I've got to make note of when you're trading spreads, notice the price that I have here for this spread right now, NQ versus ES, is $41.8950. Okay. Now, if I were to go back, oops, it's on the right page here. Hang on. No, there it is. If I were to go back and look at NQZ 2022, it's currently trading at 11,949. If we take a look at the ES, that is trading at 38.79. So if you subtract that 38.79 from 11,000, you'll notice it is not that price, 4,100. So why is it not that price? Well, because when we're using spreads, we need to do something a little different. We need to use what's called notional value for the securities. When you're doing inter-market spreads, okay, not so much an intra-market, but inter, Remember, that's related securities. Use notional value. Okay, so you're probably wondering, what the heck is notional value? Well, look it up. No, I'm kidding. I'll tell you what notional value is. Notional value is nothing more than the market value times the point value. Market value is what you see on the chart. That's it. It was a good one. Thanks. Yeah, market value is what you see on the chart. So if we look right now at the NASDAQ as an example, I was on the right, oh, no, I was on the wrong page there. There we are. So we go, or I'll be on the ES. Here's the ES, 3879.75 is the market value, right? So we got ESC 2022 market value is, as I said, 3879.75. So the point value is $50 a point. So basically the notional is going to be those times each other, which I'm not going to do in my head. So 3879.75 times 50 is 193,987. It's basically what the contract is worth. We're trading $193,000 worth of stock by trading this contract. So when you're doing spreads on futures, you actually need to do notional values for those futures. And you got to be delta neutral as well. Okay. So I'll answer some of those questions, Craig, regarding services that can help you get better. I can help you with that, obviously. And so anyway, let me go into charting this NQZ 2022 times $20, which is the point value, minus ESC 2022 times 50. That's the notional values. And you can see it's still not quite right. And here's why. Typically, when you trade these, you do two of the NASDAQ, two of the ES for every one NASDAQ. And now this should be correct for the, but basically what we're charting. You got the NASDAQ times $20 per point and two of the ES times $50 a point. And I think I might have the wrong contracts on that spread that I charted up. But anyway, if I go back, I had it right, hang on. Right here, if I go into auto spreader, let's see, where is it? Oops, not there. Oops, that's the matrix. If I go into auto spreader, I got to create these spreads sometimes. And I forget where the heck it is. Oh, it's under widgets here. Auto spreader, there we go. So what I can do is create a new spread and I have to select the contracts. So as I was saying, let's do NASDAQ NQ, there it is. And I could select NQ for December, there it is. And for the other contract, we can do RTY. See if it lets me do that, December. Now for the multiplier, I am supposed to be doing 2 Russells for every 1 NASDAQ. So there it is. So I can create that. We'll call it NQ RTY spread. Pretty simple to do. Hit save. And now if I want to go into a spread and chart that spread that I just created, I can go to Explore, Auto Spreader, and there it is, NQ RTY spread, and bring it onto my charts. And I can trade it. So it just takes a few moments for it to load. But you have to use notional values and you have to be delta neutral for these securities. So it either helps to know somebody that can tell you what they are, or you have to look them up. Right here, inter-market spreads. For instance, you got NASDAQ 100 versus Citigroup Growth Index Futures. That's a 5-to-1 ratio. You see, if it says delta right there. So you got to just know where the information is or have somebody that can help you find that stuff. Okay. So let me get back to this, and you can see the spreads, $4,180 if you want to do overnight for the bonds, or $495 as a spread. And you can even do spreads on the micros. Talk about cheap, right? If you were to go to, before I go there, if you were to go to the micro versions of these, you could actually do some trades for under $100 for margin. It's pretty crazy. Okay, now the risk is much larger. Keep that in mind. When you trade these spreads, just because you're putting down a certain amount of margin, that doesn't mean that's your max risk. You can lose more than what you put down as a deposit. Okay, so just be aware of what you're trading. So let me see, did I miss any other questions? Keep an eye on those. How do I know when to target bailout? I'll talk a little bit about that. Oops, sorry, went too far. So the risks are a little bit different than directional trading. So right here, when you take a look at a trade, this was an old one. Crude oil at the time was trading at a much lower price, $45. Remember that? Anyway, right here, the margin required was $5,200 to buy when it came into my little demand zone I was buying. And if I put my stop where I did, I would have been risking $640 per contract. But doing a bull spread, it looks a little different, but also my stop loss and my margins were reduced. Instead of $5,000 of margin, I only need $1,500. And my risk went from, what was it, $640 to $120. So you can see the amount of risk is reduced dramatically, as is the margin cost. Okay. Do I ever mix futures with options on futures? I do trade options on futures. I don't do them at the same time. Okay. So when you chart the spread and trade on the platform, yes, it should automatically buy one and sell one if you do it as a spread, if you do it correctly. Again, you got to know how to do it correctly. So anyway, showing you the comparisons there. Another thing that's interesting is that there's more scenarios for profit than directional trading. When you take a trade on a directional move, for instance, if we're going long, we only make money if prices go up, right? Doesn't matter whatever you buy. If it goes up, you profit. If it goes down, you lose. Simple. If it goes sideways, you can lose, right? Because futures are a wasting asset. They decline in value too. If we put on a spread and we're trying to basically trade for the spread to widen, there's three ways that can happen. If both prices go up, but the front month goes up further than the back month, we make money, we profit. If prices go sideways, but the front month goes up a little bit more than the back month does, we actually still profit. And if both securities go down, but the front month declines slower than the back month, you still profit. So, I mean, look at this. You got one way to make profits on a directional trade, three possibilities when it comes to a spread trade. Obviously, 3 is greater than 1. You have more possibilities that can lead to a profit when you do spread trading. That's one of the reasons why the risks are reduced. Now, because the risks are reduced, the reward will also be lower as well. Not percentage-wise, though. That's kind of the interesting thing. Another reason why people want to do spread trading is a lot of what we do is look for what the professionals are doing and try to follow them. Yeah, you can do spreads on stocks. They call it pairs trading. Absolutely, you could do that. Not necessarily, no, it's not more possibilities for a loss. It really isn't. Again, when you're looking at a spread, the only way you lose money is if the spread does the opposite of what you expected. If you have a directional trade, you have two ways of losing. If it goes against you or it just goes sideways and you waste time and money. Yeah. So anyway, the professionals do trade the spreads. When you take a look, there's something called the Commitment of Traders Report. Okay, the Commitment of Traders Report, if you're not familiar, it comes up pretty much every week on a Friday. I think it's at 3:30 or 3 o'clock at the afternoon, 3:30 in the afternoon on Friday. And what happens is it tells you what all the big traders have been doing for the past week. So it's called a Commitment of Traders Report. We fall into what are called non-reportable positions because we're smaller traders. We're not trading as much size-wise. So when these big traders come out, you'll see it'll tell you how many of them are going long, how many are going short. But right here, you can also see there's a third category called spreading. And when you take a look at all the spreads that are being created here, especially on wheat, and this one's not too old, it's about a month old. You take a look at the number of spreads, there's basically open interest on the contracts, 320,000 contracts traded in total for the week. 79,000 of them were spreads. That means a quarter of all the trading going on in the market is spread trading. So this is not something that's every once in a while we might try to do a little bit about this. For the most part, this is something that's really heavily done by the professionals. And it's kind of like their nice little secret that they don't want to share with us because it's a real nice way of trading the markets, lowering risk, lowering your costs. I like it. So, kind of the benefits as well. If you don't have a large account size, spread trading might be for you because, again, the spreads, intra-market spreads can be as low as $50. and you can control your risk with stop losses, and you always should. No matter what I'm trading, the risk is never zero. So we got to make sure we protect ourselves. The name of the report is called Commitment of Traders, COT. TradeStation actually lets you chart it on the regular program. If you go to a weekly chart of a futures contract, you can bring it up as an indicator. So that's kind of cool. So anyway, if you don't have time to day trade, as I mentioned, most spread trades are longer term. So basically you're looking at holding on to trades 60 minutes or larger. If I go out, I have a couple of trades I've been focusing on right now. Let's see, here's my September trades. This is called the NOB, or notes over bonds. Go out to a daily chart. And basically, this has been a nice decline. I forget what the call was on that one. I have to look it up. Let's see, that's August. I'm trying to find my notes. There it is. This was September, notes over bond. And what I was looking to do on this one, why can't I find it? I'm sorry, this is not the note over bond. This is the 10-year note with the euro dollars. That's what that was. And this was supposed to be a short trade on the 4-hour chart. My entry actually already did trigger, and it was at negative 122,978. I'm looking at my other screen to find it. 122,978. Let's go to the 4-hour chart. And part of the reason why I took this one the way I did, I think it was Bollinger Bands touching as well. So it was 122,978. Kind of in this area. And you can see right there, we hit the upper Bollinger Band. When we go outside a band, often you'll snap and go back to the bottom band. So I was able to enter this. What was the date of entry? 9/6. I was actually behind this. But it's interesting. No, it was 9/8. I got it wrong. What happened was, in this, two things happened. Number one, we hit the upper band. And number two, we came into an area of what we call supply right here. And that's something that I always look at. So question, when do you get in, when do you get out of these trades? There's a lot of tools, technical analysis that you can use to figure out when you want to trade them. Okay, and that's something that I focus on heavily. You can see here, we had a drop-based drop, a little supply zone. Prices came up towards that selling pressure and hit the outside of the band. And we were not in an overbought situation. So there wasn't enough momentum to break through the supply. So that was the entry for the trade. You can see it moved all the way down to that demand zone. The nice thing about doing it the way I'm doing it here with the notional value is it's very easy to figure out what the profit is on that trade. Basically, if I was getting in at 122, let me bring up the calculator here. It was negative 122,978. And the target, if we hit the bottom band right here, that was at negative, I did this wrong. Let me just do it as a positive number. 122,978 minus 123,976. And that's basically $998 profit just from that move on September 8th to right here on the 12th. That's it. So, like I said, there's a lot of different ways of trading these. These are just a few that I'm monitoring right now. This one happens to be the live cattle versus the lean hogs, or I've got gold versus silver. Or, I'm sorry, gold versus platinum. And notice this one's a ratio spread where I have 2 platinum for 1 gold. So I follow these on a regular basis. Anyway, losses are possible because you are trading with leverage. I already mentioned you can actually lose more than your margin deposit. Okay. The TradeStation web-based app, yeah, this is it right here. I had it, oops, not this one. This one you can actually, this is TradingView. I can actually link this. If I go to my trading panel, I can link it to my TradeStation account and trade it there. But the easiest way if you're trading TradeStation is use this TradeStation Futures Plus. And again, just trade on that. But I don't have all my spreads set up on it right this moment. And if I do have this open, that's the NASDAQ versus the Russell spread I was talking about. I can actually, where is it now? Oh, it's right here. I can bring in my chart trading here. Or, let's see, where is it? thought the matrix is available here. I might have to bring it up separately and then link the two, but you can do that as well, just as easily. So just gotta get used to using these tools. That's all. Oops, didn't mean to close the chart, but there's the, oh, no, it's not open. Anyway, I'm not going to find it right this moment. If you don't have a Twitter account, I'm not sure. Am I allowed to give out my email address? That's a Jesus question. I can give it out at the end here right before I leave. Anyway, you just need to know what you're doing when it comes to trading these spreads, because there is risk involved in the spreads. So continuing on here before I run out of time, kind of how to trade spreads. Well, as I said before, there's a couple different ways of trading these. You've got the intra-market, inter-market. We can trade for the spread to widen, meaning if they're going to move in a certain direction, one might move further and faster than the other. Or you can worry about the spread narrowing, where they've been moving apart from each other and you're worried about them coming back together. Okay. You can also trade seasonal spreads. Somebody brought it up, a website called MRCI. There's a lot of different places you can go to find what is called the seasonal trading for these spreads. So I have a couple different resources that I personally use, and MRCI happens to be one of those. So if I go out there, there's my account. You can see the password, ... Yeah, if you follow me on Twitter, I can give you some more information on that. Season Algo is another one that I do as well. Yeah, I do use that as well. But right here, I can go to MRCI Online. Now, don't just blindly take these trades because it can get you in a lot of trouble. But if I go here, there's a calendar that shows some seasonal spreads that they are looking at. And again, I can't just blindly take these, but there's seasonal movements that you see over and over and over again regularly. So for instance, if I go to, it's probably a better way to show it, seasonal or spread seasonal patterns. And let's say we want to look at meats. Actually, let's go to indices. Okay. So if we go to indices and you go to NASDAQ, for instance, and we look at the December versus the March contract, what they'll do is they'll show you how has it performed year after year for a certain period of time. And you can zoom in to see, okay, we're coming in on end of September, going into October. Doesn't look like this is a really good spread to trade, does it? Because for the most part, it moves a bit sideways. So if we can find where there's a really bullish or really bearish time for the last 5, 15, or 30 years, then yeah, you can trade that as a seasonal spread. So there's a lot of really good opportunities. And then the last one is technical patterns. As I mentioned, one of the things that I do in the trading and the services I run is basically I go in and try to find trade opportunities. So for instance, if I go into inter-market spreads, I have certain strategies I've created over the years. And so I can use Bollinger Bands, or I can use these moving averages like I do. And I can literally run through a whole bunch of these spreads using the continuous contracts and see, this one might be something. We have Australian dollar versus euro dollar. Okay. And I trade it very similarly to what I do when it comes to my normal trading. So for instance, I just need to put up this specific contract here. See, 2022, get rid of that continuous contract. And right here, see, 2022. So as an example, now it's already passed, but if I had caught something like this, this is what I call an area of supply. We have a drop, base, and drop supply zone right there. So the probability is high that if prices return to that area, that selling pressure is going to take over and cause prices to drop very quickly again. So what I would do is sell the spread. Again, you also have to know how you're doing it based on what you're seeing on the chart. So I'm trading, as I zoom in here to show you better, trading 2 Australian dollars that are worth 100,000 each and only 1 euro at 125,000, the notional values. So if prices came to that supply zone, I would short 2 Australian dollars and go long 1 euro. And it just missed, of course. But if it hit the zone, it worked, then it would have been a nice profit. What I did notice when I was looking at this chart was there may be a new zone that's formed just a little lower, or even this one right in here. And therefore, there might be an opportunity for me to sell the contract. Again, sell the Aussie, 2 of them, versus €1 on the long side and trade the spread. So I'd use technicals to find those opportunities as well. Okay. So when it comes to intra-market spreads, again, we have either a bull spread or a bear spread. And it's commonly used when you expect the price to either go up or down in a security. So we're using this instead of going long or short on the security. Why? Well, again, we have more volume on that front month. And because you're trading both long and short, you're taking the directional move out of it. You're simply trading that kind of accordion movement of the price of the two contracts. So if they both go up or both go down, it doesn't matter. You're directionally neutral. And therefore, you've reduced a lot of your risk and also your margin costs, which is pretty neat. So spreads will typically narrow quite often if they get out of whack, so to speak. They don't move 100% of the time. There's highly correlated securities that normally move together. Sometimes one of them moves without the other, so you can trade for them to come back. So for instance, right here, you saw that red market move up further and faster than the blue market did. So if I sold this red and bought the blue, they come back to the normal relationship. And they can do that when they both go up, down, or sideways. It doesn't matter, as long as the relationship between the two goes back to the normal. That's all we need to trade. The soybean crush, I usually do not do the three-legged trades, but yes, you can do, if you create an auto spread, you can actually do the three-legged crush. Okay, right here, you see I can add in an additional leg. So there are things like butterflies and also crush spreads that you can get into, a little more sophisticated. You can actually go, I think it goes up to 50 legs. Not that you'd really want to do that, but there's some complicated spreads that, yeah, you can go that many legs if you really want to. Future spreads profit, do they have the tax advantages like futures? First of all, I'm not a tax professional, so you need to consult with somebody. But because you are trading futures, they have the same taxation as futures do. Yes, spreads on futures are the same as trading future spreads. But again, verify that with a tax professional. I am not one. Okay. In a way, it is recognizing arbitrage. Yes. And let's see, does TradeStation offer reduced spread margin rates? Yes, they don't show them on that website, but they 100% do give you that reduced margin cost. Basically, the same calculator that you would see on the CME website is what you would use. And I forget exactly where it is on the site, but yes, they do offer the margin discount. That's it. You're looking for them to move differently. So as I said, futures also have patterns, seasonal patterns. And spreads have seasonal patterns. They basically have a spring where you get the start of an uptrend, you get a summer where strong bullish trend, then you go into autumn where things are starting to fall down, and then winter where there's a bear market in that security. So you can actually create trades based on the seasonal movements of these securities. It's not the same as a calendar, like spring is not in March, could be in October. But if you find the patterns, for instance, gold is very seasonal. Okay, right now we're hitting a time where gold starts to go up quite a bit. And the reason why, actually, I can show you if we go to MRCI, or even better, I can show you that other one, season algo. There it is. I can create a spread chart that way too, that shows me what the spreads have been. I do have discount codes for these if you'd like, if you want to subscribe to any of those. But basically, if I bring in just gold, GCZ 2022, oh no, sorry, it's just 22. There we go, gold, interactive. There we are. Whoops, didn't take it. Hang on. Type in gold, GCZ 22. Let's try this again. And there you are. So it shows me the current contract in black, but you'll see, if I zoom in, there we go. I need to do it this way. You can see the 5-year historical movement, 15-year and 30-year. Basically, gold typically rallies this time of year. This is the springtime of gold. And you can see right in mid-October, then it usually takes a little break, goes sideways in November, rallies a little bit in December. Okay, oh, no problem, everybody. Yeah, if you need to get going. Again, you can stay in touch with me via Twitter, or I guess I can do this too. Get a hold of me there if you need to. Okay. So that's my email address. But basically, yeah, what happens is we get the seasonal movement over and over and over again. If I change to a different contract, we can see different parts of the year. So I go to H23. And now they won't always, this is not a guarantee. Yeah, gold has not been rallying. You can see it's moving opposites, diverging. This is just the normal price movement historically over the time. And you can see normally it goes up and then drops in March historically. Why? Because that's the end of Chinese New Year, and that's when gold is no longer in value or really in demand. My email address is just my first initial and last name, bwendell.cmt@gmail.com. It's the easiest way to get a hold of me. Okay. So be looking to go long only if this seasonal move is likely to repeat. And you can see that right now, looking at the black line, it's not following. You know, our normal move for this time of year is the markets go up, but look at the last 5 years. And you can see in the last 5 years, we've shifted, haven't we? Last 5 years, we've been bearish from September to the beginning of October. And you don't want to buy gold until the end of September and only hold for the first 2 weeks of October. Now, again, I combine the seasonal movements with my technical analysis. I never trade just on the seasonal alone. You can't, okay? And things are not normal, right? There's a lot of things that can influence the price movements and take you away from the seasonal patterns. So you have to be aware of that. Seasonal patterns to me gives me an idea of what to look for. The technicals give me the timing to get in and out. If that makes sense. So basically with the technical patterns are probably what I follow the most. And with the technical patterns, spreads can be charted like any other securities I mentioned. So buy low, sell high, still works. Same as it would on any security. And you can also sell high and then buy low. So I use certain tools, my RSI, Bollinger Bands, and look for the patterns in the markets as well as what I call supply and demand. I don't use traditional support and resistance, even though I've been training on that for many, many years as a CMT. I found that what I look for is institutional trading patterns. And I kind of, again, I've been following this for quite some time. Get some weird noises from the Futures Plus sometimes. But anyway, that's what I follow typically. So when I start looking at these charts again, going into a spread, just like I had before, I showed you, I can look for these patterns that tell me when to buy, when to sell. So as an example, if we want to do an intraday, let's do this. NQZ 2022 times 20 minus, we'll do YMZ 2022 times 5. That's the NASDAQ versus the Dow. And if we went all the way down, back to a 5-minute chart just for fun, you take a look at what happened today in trading. So if we got the morning here, 9:30 a.m., there it is. Oops, wrong one. That's what I wanted. So there, 9:30 in the morning, this is the spread chart on those securities. Yeah, there is a demo on this. I'm in simulation mode right now. You have to go here and you can change it. Just got to learn. They have some really cool videos on how to use this Futures Plus. And actually, while I'm thinking about it, there's going to be a getting started session coming up. Jesus, I think, will talk a little bit about that pretty soon. So if you're interested in learning more about this program, which is actually pretty cool, like I said, I'm not using it and giving it enough justice right at this moment, but I can go in and create charts. There we go. Just pop out. Oh, that's where it was. MD Trader. That's what I was looking for. There's the MD Trader for the trading of that security, or I can simply do this, open chart, and it'll open my chart for me. That's what I was looking for. So anyway, he's going to be doing a getting started session on that. So you can learn all about this program coming up, and he'll give you the info on that in just a little bit. But yeah, there's my chart on that spread. But anyway, going back to this one that I was looking at, for instance, if I look at this chart before the market opened this morning at 9:30 in the morning, looking left and up, I can identify areas where there's massive selling pressure that might cause prices to drop. And I might be able to take advantage of selling the spread. And I can look back to see where would be my demand, where I'd want to buy to cover. So we got one right here, possibly. I'm not going to do too much in detail, but there we are moving up. It overshot a little bit, but my RSI was warning me it was likely to do that. And there we go to the next one, same thing. It told me not to sell. And now that we came up here, I don't know if there's a zone there too. Yep, might be. But the main thing that I'm seeing right now as we come into this particular zone is something called divergence. So again, as a CMT, I had to learn a lot about how to do proper technical analysis. So here we are coming into this final zone, even though I'm still very overbought. And that's funny because a lot of people think if you're overbought, you should sell. To me, overbought is a strong trend. It's going to keep going unless you do something like this. Prices have made a higher high, but there's a divergence here, which is telling me now it's time to short at that supply. And there the spread just collapsed. Again, this is notional value. So if I did this entry at noon today and got out when it hit, it didn't actually hit my target yet, but if I got out when I saw it turning around right here, this is actually a positive divergence, which is a signal that prices are going to bounce. We can see that the movement was from 85,920, and the exit was approximately, we'll call 84,000. That was a $2,000 move today. And I just have to look up to see what the margin was, but the margins were absolutely much, much lower than they would be for carrying this normal. But that's a spread opportunity. So I typically use a lot of technical analysis to figure out where these spreads are likely to turn, just as I would on any other security. Here we are coming into supply. We actually are holding. And look at that, prices turned away from that supply zone. So I'm looking for order imbalance, basically, when I'm looking for these trade opportunities. Anyway, if you got any questions, I'm going to stick around, I think. And I do not necessarily recommend trying to do it on yourself. You know, you definitely want to learn with somebody kind of as a mentor. Trying to do this on your own can be very, very difficult, even if you've been trading for a little while. It's something that, again, there's not a lot of sources out there that really just kind of spell it out for you. I definitely do teach this. I've been teaching it for many, many years now, as well as trading it. So if you wanted to get some more information from me, again, the easiest way is on Twitter right there. But I also did give out my email address. I'll do it one more time real quick. You can catch me at bwendell.cmt@gmail.com. So we got more questions there. So I kind of went over my time here, but I think we do have a little bit of time for questions. Are we good, Jesus?
You sure? Yes. I'm not sure about everyone, but I want to learn about that 60-legged future spread. It seems very simple.
The which one?
The 60-legged future spread?
Six-legged, yeah. Yeah, if you go out to the CME website, actually under margins, let's see here. If I go to, which one is it? Agriculture. Or actually, yeah, it might be this one. But you can see some of these ones are multi-legs. Like right here, there's a 3-legged corn, feeder cattle, live cattle. So you got the meats and the food, basically. And
well, before we
going, cracking crush spreads, yeah. 50-legged.
Yeah.
I don't know, 50-legged spread.
I thought you had mentioned a 60-legged spread at some point in your presentation. Where you can add, I think you can add up to, I'm not sure how many legs to a spread in Futures Plus, but I haven't.
50. It is 50,
really?
Yeah.
Oh my God.
Yeah. Not that you would, but you can.
Exactly.
Yeah. Try to find NYMEX.
Yeah. Before I forget, before we take a few questions here for those that want to stay a little bit, I'm doing a getting started class on Futures Plus October 5th. Manolo has been sending out the link right there in the chat. He's going to be doing it again at this moment, just in case you want to learn what the platform is about, how to use it, some basic functionality that we go over, and maybe show you how to create some spread charts there as well. So if Manolo, if you can share the link right there in the chat, I would really appreciate it. And you have access to the chat as well, Brandon. So if there's any questions that you'd like to take real time, please do.
Right. Kenichi was asking about the notes that I put out there. So there they are. Yeah. Yeah, like I said, I've been teaching this for quite some time. I have courses that I offer as well regarding spread trades, and I actually help find opportunities and walk people through those opportunities as well. So the Twitter here, I just might as well type it out here again. So I got Twitter is Trader B Dub. Oops. And then email. There you go. So you can, yep, take a dip out and a deep breath. Yeah, this is a real bow tie, by the way. So here I can untie the tie and show you it's a real bow tie that I tied. I love my bow ties. So any other questions? Let's see. Oh, swing trading in commodities is rollover also when they ship products? No, actually, you have what is called the rollovers, the process that you need to do before the expiration of the security. Then you have what is called the first notice day. And the first notice day could be, usually it's after the expiration, but it could be before. That's when you have to notify the broker that you actually intend to get delivery of the underlying commodity, and then they'll have delivery. And all that information is given on the CME website. You know, most of the time we don't really want 40,000 pounds of lean hog showing up at our driveways. So we usually get out of the contract before the expiration. But let me see, I've got right here, I can go to rchart.com. I've got tons of resources. But right here, if I go to futures, contract, there it is, futures expirations, you'll see notice dates as well. So if I go to expirations, you definitely need to be out before the expirations. Let's say we go to livestock and we got live cattle. You can see the October contract stops trading on the 31st. Rollover will typically be a week or so before that, maybe even sooner. And then when you go to the next one, which was the first notice dates, again, we go to livestock there, you can see that's actually 10/10. So you need to be out of that contract before the first notice date, not before the expiration in this case. Whichever one is first, you got to be out, either the expiration or the notice date, because you do not want to get notice that you need to be ready to take in 40,000 pounds of live cattle. And that's a lot of hamburger. So you just got to be careful there. Okay. So
in regards to future spreads, these can only be traded on Futures Plus. So if you already have a futures account with TradeStation and you're trading futures on the TradeStation desktop, that's perfect. But if you're interested in trading futures spreads, you'd have to set up an account that links to Futures Plus. So reach out to your account representative and ask them what's involved and what do you need to open up an account with Futures Plus. And I believe the commission structure is pretty straightforward or similar to what's on a regular futures account, but also ask your account representative about that for a little bit more clarity.
Oops. Any other questions for me? Hopefully you got a good understanding of what they are. And if you're interested in learning more, like I said, you can contact me. I can give you more information. More than happy to do that.
Excellent. Well, thank you so much, Brandon. We appreciate your time. We appreciate your expertise. Very interesting content. We're going to do everything possible to have the recording available to everyone. I'm not really sure where exactly it's going to reside. I mean, that all depends on compliance, but usually these type of presentations, we post them on the TradeStation YouTube channel, but we'll keep you posted. If anybody has any questions, please reach out. Manolo has sent out the contact email for TradeStation. I believe it's TradeStation University. Could you send that out again, Manolo, just in case somebody has a question, just reach out to us. Manolo will put it right there in the chat. So thank you, Brandon, also for sharing your knowledge with us here. I want to appreciate
Thank you again for having me.
Great. I appreciate the time that everyone spent with us as well. I know it's not easy to spend time on a webinar like online, but I do appreciate it. So I look forward to seeing everyone in our future webinars. So check out our events page right now. It's posted on YouCanTrade.com. So thank you for your time. Have a wonderful afternoon, and I'll see everyone next time. Goodbye, everyone.